Hi, everyone. I'm Karen Bunnell with O'Donnell Real Estate, and I'm here today with a fellow mortgage broker expert in the area, Ricardo Hernandez, and we're going to discuss real estate and how loans are working and what the market's like. Hi, Ricardo. Thanks for coming.
Hey, Karen. Thanks for having me.
Great. So let's talk about real estate and loans and what's happening in today's market. Let's start with that. What is happening in today's market with rates and loans, and is it still a great time to buy?
So first of all, I want to say it's an excellent time to buy. So what happens is consumers hear a lot of information that comes out on the media. Media tends to be a few weeks late as far as what's actually happening. End of the year, you had the market sort of slowing down where sellers and buyers are sort of, had that head-to-head, we're not going to budge either way. Then sellers realized that rates were in the sevens and they had to do something. So rates started to move a little and sellers sort of gave up, their leverage and said, hey, you know what, we'll negotiate. We'll give you some credits. We'll give you this. We'll give you that. So rates dropped a little. So there's more buyers in the market right now, but there's still not a ton of buyers. They're all sort of waiting for that 4.5% rate. The biggest problem with the market is there's no inventory either. So there's still a shortage of I think it's like over 3 million homes nationwide. So smart people are actually going out and buying real estate right now because they know that at some point in the next 12 to 18 months, they're going to refinance. And what happens when rates drop to that 4.5% rate is everyone that's waiting right now is going to come back in and go, hey, I want that property back at that rate or that sales price that it was going for when it was 7%. So now's a great time. I think rates will continue to go up a little for the next few months. Inflation's not going away. Prices will sort of level out where they're at right now. Then you'll get a big frenzy starting to come during summer because everyone wants to start moving and going from there.
I think there's some buyers out there that genuinely feel like rates are going to drop down to the 3 or 4s and prices are going to get cut by $200,000. I mean, there's just could you speak to that? Because when I say that's just not going to happen, I think maybe they just think I'm wrong.
So here's the thing about real estate. Real estate is one of those things that's very emotional. When people talk about real estate, they talk about their emotions because it's a big deal. You're buying a house, you're buying somewhere for your family, it's an investment. But the data says that there's a lack of homes regardless of what happens. Majority of people have rates below 4.5%, so they have no need to actually sell. So you're not going to see that big price drop because as a lender, we've been doing great jobs of giving really good loans to really qualified people. You don't have that 100% financing. You don't have the no income, no doc. You don't have that stuff that made the market sort of fall apart. So there's no chance that properties are going to drop 200,000 in the next few months. Rates are going to get cut.
Well, that makes me feel better because that's what I'm saying. And sometimes I think they just go, oh, she's just trying to sell me a house. Let's talk about loans. Let's talk about first-time home buyers. Someone that's never bought a house before, they've just been a renter. From the loan perspective, what do they need to start having to collect, get ready to get pre-qualified to buy a house?
The first thing I always ask for is how much can you afford? And there's a simple reason. The bank qualifies you based on what you make, and we have no idea what your expenses are. So we take your W-2 income, your salary is $80,000. We're taking the $80,000 to qualify you. We don't know if you have 1 kid, 2 kids, daycare, insurance, car payments, extra stuff. So we have no idea. So if you come in with the budget as far as how much you could afford, that helps a lot because it lets you sort of come in educated and then way ahead of most people.
But you have to be honest about that, right?
You have to be super honest.
Because otherwise you're just kind of messing up your own projection of where you want to be.
Exactly. And I always say, I'm not the one making the payment.
Right.
So I'll tell you what we qualify for, but you tell me what you want to pay. And let's meet somewhere there. And if we're off by a few hundred, we can figure that out. We can pay off some debt and go around that.
Right. Sometimes the best place to start is what are you paying for rent? How's that working with your budget? And kind of go from there. What documents do they need to have ready for you? First of all, how much is a minimum down payment?
So reality is there's still 100% financing for a lot of FHA loans. There's grants behind it. So if you income qualify, you can do that. If you don't income qualify, you can do that. It's a forgivable grant, not a gift. So it's something you could use. Majority of loans are 3% down or 3.5% down. And you can put as much as you want. But reality is most people come in with 5 to 10.
Okay. So from what I've seen in the real estate market, my buyers are typically first-time home buyers are about 3 to 5%. Some of them can actually put more down and just choose not to. And then what else besides their down do they typically need to show you?
So we're going to ask for pay stubs for 30 days, W-2s or tax returns, depending on what type of income you have. If you're self-employed, we want a 2-year average of your self-employed income. If you're W-2'd, we want your W-2s and your pay stubs to get a better idea what your income is. We're going to ask that you shop for insurance to get a better idea of what your monthly expenses, your bank statements, and that's pretty much going to be it.
Let's talk about credit.
Yes.
Let's talk about your credit report and how that affects your loan.
Okay. So,
and that you run that, and you can do 2 kinds of pulls, hard and soft. So explain that.
So a soft pull doesn't show anywhere. A soft pull sort of just takes the information on the background and we go, hey, here's your credit, and it gives us scores. So we could actually use that to qualify you. A hard pull is actually going to show on your credit report as an inquiry. So we run credit, we take the middle score out of the 3 scores that you have. So if you have 780, 700, 620, your credit score is 700. And a lot of people assume that it's going to be a lot higher. Some people go on sites like Credit Karma, other credit cards, which is always way off. And the reason is it's
I didn't know
different.
that.
Well, it's different risk factors. So
Okay.
a credit card is a short-term investment that a lender makes. So they look at it on a monthly revolving basis. Will you pay your debt? If you do, you get a higher credit score. When you look at a mortgage, it's a long-term debt, so the risk factors change. So we don't care much about that 30-day account. We care more about that 5-year car loan.
Right.
That has a greater impact on your score because that's going to show if you're going to pay your bills more or pay your mortgage.
Okay. And in terms of having you pull credit, a lot of people think it's going to change their credit by like 100 points. What's the truth of that?
In reality, it's like 5 to 10 points. And the consumers are smarter nowadays. So before, if I pulled your credit and 10 other lenders pulled your credit, your score would drop by like 50 points. But now they know that you're not going to go get 11 mortgages. So you're going to drop the one time. And as long as you're within a window, your score is not going to drop a lot. But consumers are savvier. They are shopping more. They are looking around for what makes the most sense for them.
Awesome. Thank you so much. That's awesome information for our first-time home buyers.
One more thing I would say about credit that a lot of people don't tell you is you can always manipulate your credit score based on creditors report to the credit agency once a month. So if I have a credit card with ABC Bank and my statement closes on the 30th of the month, I could pay down my debt on the 28th and not use it till the 2nd of the following month. And they're going to report that lower balance, which will bump my score up. So.
And how does having a good credit score affect your loan rate?
Your credit score affects how much you pay. Everything is called risk-based pricing, meaning the greater the risk, the higher the pricing. So the higher the score, the lower the risk. So
if you have a low credit score, it doesn't mean you're not going to get a loan.
It's just going to be a little more expensive.
A riskier loan, so a little bit more expensive.
Correct.
Okay. And then last question on loans, going to shop around different loans, what is the difference between the different people that you can call to get loan rates?
So there's a lot of avenues to get a mortgage. Reality is everyone's a third party. Like the simple fact is, I always laugh because everyone's a third party. I'm a mortgage broker, so I'm a third party. I used to work at a retail lender who's a third party. So unless you're going directly to like a Fannie Mae and Freddie Mac, which you can't, you're going through a third party. So reality is someone says, I'm a direct lender, or everyone's going through a direct lender at some point. It's just a matter of how you get your money. Your financing cost is going to vary based on overhead. So I always tell people, do you want to pay $20 for the Starbucks coffee, or do you want to pay like $4 for Starbucks, or do you want to make coffee at home?
Exactly. And then last question on loans. How long do you have to hold your loan before you can refinance? If somebody wants to buy now, they're sick of renting, they want to be paying their own mortgage, even though the rates are a little high, they get into it. How long do they have to pay the higher rate if the mortgage rates drop before they can refi?
The honest answer is 1 day.
Oh.
Lenders will tell you that we prefer you keep it 6 months, because reality is when we sell the loan, the servicing says that you're going to maintain that loan for 6 months.
I see.
We can't charge you a prepay. So reality is you have the right to do it whenever you want. I can't tell you otherwise.
Is it just more expensive if you do it before 6 months?
Not for you. For myself, yes, but not for you. So
okay, perfect. All right, well, thank you for those. Okay, let's talk about maybe a little bit something not so fun. How do you keep your clients from having their loan fall out? And what are those speed bumps that make a loan not make it to the end?
So the first thing I would say kills a transaction is time. The longer it takes, the more likely something will go wrong. It's just simple math. Second thing is going to be taking on new debt. A lot of clients take on new debt before their transaction closes, and when we look at qualifying again, they have new debt that appeared out of nowhere, and we have to factor in, which
Okay,
changes
so
qualification.
to be clear, that means once you start the mortgage process, before your house closes, don't go buy a new car.
Correct.
Don't go.
But I would even say before you start the mortgage process, because like I said, they report to the agency once a month. So I'm going to go buy a house, and I know I'm going to buy a house. But before I do that, I want to buy a car. So I didn't buy it during the process.
Right.
And I follow the rules. I didn't buy it during the process. But when my mortgage lender pulls my credit, they go, hey, you had a inquiry with this person. Did you get new credit? The lender qualified you based on the information on the credit report.
Understood.
When that $1,000 payment comes in, it changes the whole transaction.
Interesting. Okay, so during the time frame that you're in escrow, sit tight.
Correct.
Okay. Do you have something else to say?
Well, I was going to say don't switch jobs. Or if you do, switch jobs to something that is sort of similar or makes sense.
Or better.
Yeah, I know.
If possible.
Yeah.
Okay. All right. That's all good information. Let's talk about what's your most common mortgage question? Let's spread some advice and information around. What are you most commonly asked when it comes to mortgages?
It's always what's the rate.
Always, what's the rate?
And
that's what I'm asked. Like I'm the mortgage lender, but no.
Like we have professional rate shoppers, and I always tell people you're looking at the wrong thing. You're looking at the rate where, hey, I want this rate, and I go, fine, what's your cost? Because every rate has a price attached to it. So when you go and you get a rate quote, there's a price attached to it, which means you're either going to pay cost or get money back. The higher the rate, the more money you get back to our closing costs. The lower the rate, the more you pay. So I always ask is, how long do you plan on staying in the property for? Because there's always a break-even point that has to make sense. So if you're someone that goes, hey, I really want to rate in the threes. I've had people say that. I've had people, how long do you plan on staying there? I'm moving in 2 years. I'm getting a new job, and I'm moving to the East Coast. Okay, great. So reality is you should take a rate at 4.5%, pay zero cost, because the difference, and they go, I really want to rate in the threes.
Well, the fact is that the extra fees that you pay to bring the rate down, you never get back.
Correct.
So how much are you willing to bring that rate down? It only makes sense if you do the whole equation.
Correct.
If you're going to stay in it long enough to kind of equal out the fees that you pay to get the rate lower.
Correct.
If that made sense.
No, it does.
Okay.
And like a lot of people are ego driven when it comes to rates.
Right.
So they go, I don't care about the smart thing. I want to rate in the threes. And
Right.
you're like, okay.
Yeah,
So
like my neighbors all have rates in the threes.
Yeah.
I want one too. Well, it was a different time.
it's
Okay.
very emotional. So what's the rate?
That makes perfect sense. Okay, so the last question is, what are the biggest mistakes that people make? You've been in this industry how many years?
26 years.
26 years. What are the biggest mistakes? Like, spread your advice.
So I see a lot of people not hire a professional, which to me is mind-boggling. Everyone has a friend, a cousin, an uncle, or something that does a service that you might need. I know you're trying to help, but if they're not good at it, don't do it. It could cost you way more money in the long run. A lot of headaches, a lot of things go sideways because people don't hire a professional. And I always say, like, if you needed a good dentist and your cousin said, hey, I went to dental school for 2 years, but stopped. I haven't practiced dentistry in 15 years, but I could help you.
Yeah, I really didn't like it. I didn't like working on people's teeth, but I can fix your root canal.
Yeah. It's not a good
I would
idea.
go there.
So if you go to like a realtor or a lender that does like one transaction a year, it makes no sense. They're not good at what they do. They don't practice enough to be professionals. So hire a professional, hire someone that knows what they're doing to make your life a lot easier, because it's a very emotional process. The transaction itself is just draining emotionally because so many things could go right or wrong at any given time. You need someone that knows how to navigate that process to make sure that you don't know about it. Because reality is, on every file, there's at least 2-3 things going sideways. We get it figured out on the back end, so you never have to hear about it. Now, someone that doesn't know what they're doing is going to call you every single time and go, hey, this is bad, this is bad, this is bad. So hire someone that knows what they're doing.
Yeah, 100%. Like with everything in your path, right?
Yeah.
Not just loans and real estate, but for today's purposes, get someone in loans that knows what they're doing so that you don't have any problems, that you have your questions answered and they know what they're doing. Same goes for my position in real estate. You want somebody that knows what they're doing, that will put all the effort in to make sure that your process goes smoothly and you don't have the anxiety that you can endure. At the end of the day, buying a home is an expensive thing in Southern California, no doubt. And it's typically everyone's biggest purchase. It's bigger than any car or, renting. It's a huge purchase. And for me as a real estate agent, I want my clients to love their home. I don't want them to just say it's good enough. I want them to love it. And I want them to know that I'm just as invested. Even though it's not my money, I want them to find that home that they love and that they feel good about. And I want to have the least amount of problems as possible. So for me, it's super important to make a connection with my buyer's lender so that I can communicate with the lender and help my client through the process. That's one of the reasons why I work a lot with Ricardo.
Yeah, and Karen, I work with a lot of agents. You are definitely emotionally involved with your clients as well.
Thank you.
Which
I'll take that as a complete compliment.
which is an extension of like as a lender, you get what's called guilt with the client. Like if something goes sideways, you get guilt because you're like, I should have been able to fix that. This shouldn't have happened. With you, I get guilt with you because you're so attached to the client. If something goes sideways, I'm like, oh, we should have known that was going to happen. Like, so, and that's a good thing because it shows you are invested in your clients.
I definitely am. And I'm a conservative person by nature. So I like to cross my T's and dot my I's and to make sure that I know anything that could be happening in the future, that I've looked into it and that I've sorted it out. I communicate with the listing agent. Now, let's talk just lastly about what you just said. You wouldn't just call your friend who's a dentist and have them work on your mouth. So as a real estate agent, in terms of listing a home, today's market is very competitive. Homes are very expensive. And a lot of sellers go for the agent that will give them the lowest commission. Well, what can you sell your house for? I'll give it to you for this amount. And so some people go with the agent that's just the least expensive. And just to say that's not always the best thing as well. You want an agent who knows the area, who knows the market, the schools, the competitive properties in the area, can do their homework and their research to make sure that your house is on the market for the right price, and that it will sell because you're willing to do the open houses and the marketing and to get the word out. It's more than just what am I paying the agent in commission. It's so much more than that. You deal with lots of agents, I know, and I'm sure you've seen your fair share of people that cut their commissions, and it's apparent with the work they put in.
And you'd be surprised what someone's value is when you look at someone selling their home. You have clients come in and say, hey, I want to pay that 1% listing fee and sell it. And someone goes, great, I'll do it. Perfect. It doesn't sell. You have someone go, hey, I want, the 3%, but I want you to invest $10,000 in your home. We're going to raise the price $50,000. And they're like, that's crazy. Why would I do that? I just did a 1%, didn't sell. Well, your walls are too ugly. That's too outdated. So if we just invest here and we change this flooring out, it's actually something people want to buy.
Yeah, and you'll sell it for more. You'll get all that money back.
Yeah, and it's just people knowing what they're doing. Same thing, hire an expert, because if you're in a certain area and everyone wants wood floors, but you don't have wood floors, guess what? It might be your good investment, put in wood floors and spend that money because you'll get your return down the end.
100%. Okay, a few more questions. Let's talk about escrow. You've looked at homes, you found some homes you liked, your loan's pre-approved. Talk a little bit about the escrow process coming from the loan officer perspective. What does that all mean?
Okay. So it's super important because escrow is that third party that sort of keeps everything moving together. We have a buyer, we have a seller, we have a lender. And escrow is in charge of keeping all the paperwork together.
They're non-biased in the middle.
Correct. And their job is to make sure that everyone gets paid. So they make sure the seller gets their money, the IRS gets their money, the bank gives the money, the buyer gives their money. So a lot of people prepare for their loan, but they don't worry about the escrow process. Because escrow is going to send you a ton of paperwork as well. They want to know who your insurance is. They need you to sign disclosures. They need to know, make sure you have wire instructions because you have to send them money as well. So everyone, there's a process that needs to happen to get escrow opened. And a lot of people just worry about their loan. Great, I'm done. And when they hear about escrow, they start to freak out because they didn't know they had to wire money to this person, not this person, go through here and there. So Escrow is super important, and that's one thing I would say is make sure that you know what to expect when it comes to escrow, which is a lot of paperwork.
A lot of paperwork. And maybe another day I'll have an escrow officer come in and
Yeah.
kind of talk a little bit more in depth about that process. But the short story is that you have kind of deadlines in your escrow process. You have inspections, you have appraisals, you have loan contingencies and different speed bumps. And the escrow company walks you through that process. Because they're non-biased third party, buyers and sellers alike should call escrow if they have any questions. Most escrow, in my experience, have been amazing for my buyers that have questions and can answer any questions that they have. But the short story is it's a lot of paperwork.
Yeah.
It's a lot of signing documents. It's a lot of crossing T's and making sure legally everything is documented and signed. But everyone pretty much goes through the same process. So
Everyone goes through an escrow process.
okay, so let's talk about after your house has closed. You've got your loan, you found your house, you've closed escrow. Now, what are some things that you can start entertaining after you've closed?
So the first thing I recommend you do is you get all your loan paperwork and you scan it somewhere and you put that in a file, a Google Drive, a Dropbox, whatever. You want to save that for your whole life.
If you close with me, I'll do that for you.
But it doesn't matter how many times you refinance, you want to always keep that. Just because if you ever sell a property, you want to make sure you have a record of all your costs during the process that you own the home for tax purposes. You also want to make sure that you sign the correct note in case something comes in correctly or there's some verbiage that changes throughout the process. You have that paperwork there.
Yeah, I mean, and if you end up refinancing, what we can talk about in a second, you will want to have those documents available to look back on.
Yeah. Just because you want to figure out your costs. You want to figure out where you're at. Refinancing is a thing. And so I started doing this in 1997. And back then, I remember rates dropped from 8.5% to 6.5%. And there was a huge refi boom and crushing it. And people were like, oh, yeah, the 2% rule. I didn't know it was a 2% rule. Now, to me, it's simple math. What's your cost? How much are you saving? When do you break even? So if you refinance and you're saving $100 a month, but it costs you $1,200 to do, after a year, you're saving $100 a month.
Exactly.
So it all comes down to math and when it's profitable and when it makes sense. So refinancing is definitely an option that most people take advantage of when rates drop. And rates will drop eventually. So everyone's going to refinance again. So.
What else could they think about? What is a HELOC and how do you do that?
So HELOC is a home equity line of credit. Over time, as you build equity, there's an avenue to tap equity of your property without touching your first mortgage, meaning the terms on your first mortgage remain the same, but you take out a second loan, which you could use sort of like a credit card against your house.
Or to fix up your home.
Yeah. Most people use the equity in their home to either buy a home or reinvest in their home. So it's not very uncommon people do that.
That's exactly what my husband and I did. We were in our house for 8 or 10 years. We opened up a HELOC and we remodeled our kitchen.
Oh, nice.
And then we did it years later and we bought a second property. So you can pretty much use it for whatever you want. The differences on a HELOC and your regular mortgage is most HELOCs, and correct me if I'm wrong, are adjustable. The rate.
So HELOC is adjustable because it's like an open line of credit. Now there's a home equity loan, which is fixed, but a HELOC, because it is an open line of credit, you can't fix that rate unless you fix a portion of it. And some HELOCs will let you go, hey, you know what? You took out $50,000, you can fix that portion in for the next 20 years, but the rest is still variable because it's based on prime and whatever you borrow it for.
Perfect. Two other things I'd like to talk about after you close on a home, and we can bring some experts in to speak to this, is getting some life insurance. This is not home insurance. This is not insuring your home and liability within your home. This is life insurance. And why is that important, do you think? I know you're not an insurance expert, but...
This is one thing that I'm shocked how many people don't talk about. So let's say you have a married couple and you have a 2-income family and they both work. They're both making $100,000 a year and they both contribute to the payment. So if one person were to pass away and there's not enough insurance to cover that portion, that other person either has to get another job to supplement the additional
Make their
100,000,
mortgage
or
payment.
sell
Right.
or sell the
home.
sell the property. So if you have insurance to cover at least your mortgage balance, it lets that person sort of either stay home, because there is a mourning process that you have to go through. So
Sure.
there's stuff that needs to happen. So it's not feasible for one person to just take over all responsibility. So life insurance is a great way to protect yourself as an investment, especially if you have like kids, because you want to make sure that you're not leaving your partner or whoever's there behind to just sort of try to figure it out. And that's huge.
Yeah. I mean, it's tragic when those things happen, but life insurance is just that other step to adulting when you have a house to just insure your brand new, very expensive California asset.
Yeah.
Just like you have car insurance, but put it with your home price tag, and that's how much more important it is. In addition to having life insurance, which is protecting your house, speak a little bit about, and I know you're not an attorney, but why is a trust important? Again, you have to pay for your life insurance, but it's important, and you have to pay to get your home in a trust. But what does that mean?
So a trust is basically you create a separate legal entity, which you still own and you're still a beneficiary of. And all you're doing is protecting your assets. And my best way to explain it to clients is, okay, let's go. We'll use it for, okay, so let's say you pass away and Ed is left with 2 kids and a house. Who owns the house?
We both do.
But you passed away. So who owns the house?
So he does.
Okay. So
And still the bank.
okay. So let's say
Sadly.
let's say Ed gets remarried, and he's remarried, and Ed passes away a few years later. Who gets the house? The kids, right?
The kids.
Wrong. His new wife does, because California is a community property state. Community property goes to the spouse regardless of what happens. So
Unless
it's in the trust.
it's in the trust.
So the trust is a way to protect your assets, where you're able to structure the way you want your living will or your estate to go. So one, it protects your assets from. I hear lawsuits. I haven't
Exactly.
been lucky enough to find out, but I mean, it protects you from that. But 2, it protects your assets to make sure they go where you want them to go.
Where you want them to go.
Especially in
And
California.
the short story, the difference between just having a will and writing all that down, God forbid you pass away, why is a trust better than a will?
So you could always contest the will saying, hey, that wasn't their intention. You could always, I'm assuming you can do it with the trust, but reality is a trust, you're breaking down specifics as far as what it is. And ultimately you're trying to avoid the probate process, which is the most expensive piece. If you have one person say, well, you know what, Karen, before she passed away, actually owed me $100 and I want that out of her estate. And you have 100 other people say, well, she owed me $100 too. It goes through that process of figuring out who's really owed $100. Where a trust says, hey, you know what? Here's my estate. Here's where it goes. Here's where everything goes, and that's it.
It's all done by an attorney, a trust attorney, an estate attorney, and typically you package it with some other very important documents. But the short story is if you have a trust versus a will, it doesn't go through probate because it's all been notarized and legally done by an attorney. You can get a will off the internet and write what you want. And if you pass away, your home, your asset, which is what we've been talking about today, all of that money, that value of your home goes through the probate court, and California court system takes a large portion of that, and typically lots of problems follow. So it is an initial expense to get a trust, but it will prevent lots of things in the future and protect your asset, which is what I'm all about.
And the biggest thing people don't think about when they look at assets is their kids. So it's funny because our trust is structured where if we were to pass, the money would get put in a certain account and our kids would go to certain people, and money would be set aside already for that new family to go ahead and take care of the kids and establish the college and all that as far as what they need. So it's structured where we know exactly where our kids, based on our trust, where our kids will end up and how much money they'll get during what portions of their life. And if they want to open a business, great, go fail. Let them fail, then you get more money later. Like it's all structured where that's a big asset, but people don't think about it because they go, I have money and I have real estate.
And also, I think the biggest problem is people don't know. People don't know it exists. They don't know what it does. They don't know why they need it. So getting the information out and the importance of what it is and why it's important to initially spend that money to get all your ducks in a row and have it all notarized and legally done so that, especially when you have children, like it's one thing to just be a husband and wife and protect your spouse.
Yeah.
It's another thing when you invite children into this world, you want to keep them safe and protect them. And this is the best way to do it. Well, thank you so much for coming today.
Thanks,
I really
Karen.
appreciate it. We'll do it again.
For sure. Thanks, Karen.